Hello folks, welcome back. This is our last analysis commentary video, but not last teaching, because I have one more video next Wednesday. So there won't be any video between today and next Wednesday of next week. And then we'll resume January 3rd, 2022 with the commentary schedule. Just so you know, there was no video posting from the forum last night. Friends and family came over and surprised me with a visit that I wasn't expecting, and we went out and had some dinner together, and it was good times. So nothing really exciting happened anyway, so we really didn't miss anything, but nonetheless, there was no video for yesterday. So it's the holiday season, it's time to be festive, so do the same thing, okay? Put charts away, put trading away for a few weeks, and just enjoy your family. But with that said, let's go into this short video. As a Christmas present to you, it will be a real short video. Okay, usually when I say that, it's like a long marathon. You don't need to stop and get snacks, okay? All right, daily chart, dollar index. We're still inside the consolidation. It hasn't really moved outside of it. We have buy side building above here, and then we have the weekly imbalance, and then we have a sell side imbalance right in here. So we have fair value gap in the form of a buy side imbalance, sell side inefficiency. Sell side below that low takes us into here. Buy side runs here, and then maybe even to the weekly imbalance. We have yet to really move outside of this consolidation, so nothing has happened. For those individuals that have always questioned why I teach and promote the idea of not doing anything during the month of December, this has been a perfect poster child for that very reason, because this is typical of December. Hourly chart here on the dollar index, you can see the old dealing range high and dealing range low, and we are stuck in that. We had this one little event right here running up to the daily premium rejection block, and then we have basically been respecting this dealing range. And I said until we lift this definitively, we're going to stay in a range. Add that to the economic calendar and the seasonal time of where we are, where it's the close of the year, no real risk is being assumed. No one wants to risk what they've already made, or assume risk and take a larger loss than they may have shown for the year. So risk is not welcome at the moment, and that's the reason why you're seeing really no real interest to see the move higher or lower outside this range. But if you ever doubted, because I forecasted this dealing range as a critical factor in the future movement of the markets, so as long as dollars being held in like this, you do have crosses that you can trade, but I'm primarily focusing on teaching you to follow your markets, okay? And while you may not agree with euro and cable being your markets, I'm doing it because they're my markets, okay? So I'm teaching you how to observe, trust the market conditions, navigate, and also I'll add this in here and still keep it a very short video. The idea of the last group that just came in, 2021, okay, congratulations, because you've basically made a full calendar year, with the exception of a couple more weeks. But basically you did it, okay? Congratulations. We've had a few drop off throughout the year, and that's normal because it's a lot to retain, and a lot of people just don't have it in them to learn. But now you have a baseline foundation to a calendar year. So you've witnessed me navigating the entire year, knowing where the market should likely draw to, and when there's going to be problems. In other words, where the market is likely to be difficult in determining a directional bias, where the long-term higher time frame charts would draw to. And you watched me when there was times where I just simply didn't know what to expect at that moment, but I would outline what would give me more insight. And then when those things happened, then we would get back in sync with the market. I forecasted this very range here and told you how critical it was. And you can see, you can't argue with this. Like, we are stuck in this particular dealing range. How did I do it? How did I call it? How did I outline it? And why was I suggesting this was the range that was important? Because you can look at the consolidation and frame it up in multiple ways that wouldn't necessarily lean on the logic I gave you here before the fact. This dealing range was established during Powell's testimony and speech during the week of non-farm payroll. So they reversed the non-farm payroll event that usually comes with some kind of a knee-jerk reaction on employment data that usually creates a Judas swing, and then you can usually work away from that for the first couple weeks and maybe even the entire month of the trading that takes place after non-farm payroll. But add to the fact that they reversed that order by throwing in a big volatility event at the beginning of that particular week. Powell said whatever he said, and I don't care what he said, but the established structure based on what he spoke that particular day set a dealing range, and then non-farm payroll was really unwilling to work outside of that range. And then you add to it, it's the last month of the year, close of the year coming up, no real risk is wanting to be assumed, and or positions will be squared. In other words, any positions that have been held over the year will likely be squared away. And that doesn't necessarily mean a strong reversal of sorts. So until we left this range, I outlined and gave you visibility in terms of what to expect for this month. And for the most part, it has done it beautifully. We do have sell-side liquidity down here, and we had a little bit of an imbalance there. Relative equal lows, sell-side below that. Went up towards the top end of the dealing range high. Notice that. Failed once more here. Broke down, went through the imbalance. Consequent encroachment. Sells off. Short-term draw on liquidity would be in here because we have another low over here as well and over here. And then do we need to go back down below the dealing range low here and work towards that fair value gap in the form of a buy-side imbalance, sell-side inefficiency on the daily chart? I don't know. But here's the beautiful thing. Given the time of the year, I don't need to know because I'm not going to engage. So it releases me of any necessity about being right. And I'm electing to go with being plugged into the family and plugged into the holiday aspect of this time of year and not trying to gamble, trying to get that last bit of juice, okay, out of the lemon squeeze in this calendar year. You don't need to do that. All right, so 15-minute time frame dollar index, you can see again, failed to get through the dealing range high, failure swing, breaks down, the imbalance on the hourly chart, consequent encroachment here, breaks lower, sell side resting below here. There is a lot of buy side building up here, so this actually aids in that in terms of building up a lot more sentiment for a bearish dollar, which I like to see that because I like to see it eventually get taken and used against retail. All right, Eurodollar daily chart. Now again, much like I just said in the dollar, but it's even better displayed and showcased here in euro. This is that same dealing range here on that particular day. And then we had the range. Did we leave it? We poked through it here and we poked through it there. But look at the bodies respecting that range right there. Why is this occurring? Because I outlined the fact that everything around the calendar month, the end of the year, the fact that they started non-farm payroll week with Powell speaking and it gave you the biggest volatility move of the week. And then nothing has happened since. We've been stuck in that range. Every Tom, Dick, and Harry have been out there trying to force a trade expecting euro to go lower or go higher. And they're getting chopped up in this range. In the times where I drew down on the accounts and blew them, in the 90s, these were the times of the year and the times of this month where I would try to get more because I wanted to make more than I did the last week, the previous month, I just wanted to gamble. That's really what I wanted to do. And it never panned out. Not well, it didn't. It always panned out as a blown account, and I lost forcing in this environment. That's the reason why I teach and preach, and hopefully you'll look at it as valuable too, and just say, you know what, I don't need to trade in December. I don't need to trade during the week of November. I can just enjoy the holidays. Let everybody else out there play lottery, and if they catch a move and it moves big for them, great. But that doesn't mean you had to be a part of that move. And anyone that would ever argue and watch, and because we've had years in this mentorship where I hold this same view every single year. I don't want to trade during December. We're seeing a classic rendition of that delivered right here. This is exactly what I refrain from, because I have lost accounts forcing ideas and opinions back in the 90s, doing this very thing right here, expecting a big move. Because my mentor, my first real mentor, Larry Williams, would talk about this thing called a Santa Claus rally. And while, it still could materialize, we could still see it pop. We could still see equities pop up. We have a lot of things going against it. Like, we have a weird, gloomy cloud of uncertainty with all this germ warfare narrative crap that they want to promote and shove down everybody's throats. Supply chain issues and just a total rampage on liberties, rights, and freedoms. So while it can be very easy for me to go into a rant about that, I'm going to spare you that. But no one can argue that this wasn't forecast beforehand in here. Like, we are in this range, and before we see any sizable moves higher or lower, this range has to be definitively given way. Like, it has to be left in a manner where it's decisive. And we have held this range. And I took your attention to that range the entire month. Before the fact, I told you, I said, this is going to be a significant range. It's been established. So we're going to be dealing with scalping on 1 and 5 minute charts. Or you're probably going to be frustrated because it's going to bang around inside this range. And I don't know. I have a preference. I'd prefer to see the dollar go higher and the euro go lower. That was my preference. But I admitted openly that this is a time of year you shouldn't be even demo trading. But observe what's going on here. Like, how can you argue against that? That communicates the very thing I teach you, why we should expect to just sit on our hands and not do anything in the month of December. There's other months in the year. There's certain periods in the year and seasonal tendencies where you really want to focus your attention and try to capture and harvest the bounty for that particular spring season or fall season. And then we go into winter. Winter is December and January. Those are the months where I do not look to harvest anything because I'm not exposing myself to risk. I'm not losing anything. I don't fear missing out because I know there's going to be bigger, more precise type of setups and structures in spring and fall. Now, all of you, with the last group that just came in, again, you deserve a congratulations because you weathered a full calendar year. You've witnessed things that you wouldn't otherwise expect to understand or even understand the benefit. And this, to be honest, you really probably don't understand the full benefit of knowing what you've been exposed to over a full year. But when we rotate and go through it all over again next year, the beautiful thing is none of you have to pay anymore. There's no new students coming in after you. And you'll see all the things repeat again. And it'll develop a better understanding and appreciation before, never having done this, your perception of price is only limited to give me an entry technique. Give me an entry technique. Where now you have a macro perspective that was outlined to you every single week, most days. I didn't do it every single day, but I sat down with you just about every single day, gave you the logic of why it should do what it's likely to do. And you can look back and see the times where I was right and when I was wrong. And when I admitted to you, I didn't know what to expect at certain times. And then I would tell you, don't do anything because it's not going to do what we would like to see in terms of high probability. And then I outlined the entire month of December. And here we have it. It's exactly what I framed based on what I teach you the algorithm is going to do. If there was no algorithm, if there wasn't a logic used by it, and I wasn't aware of what it does, I would not have been able to outline that particular range. There's no logic in anything else out there that would take your attention to that and frame everything I've outlined for this particular month. Consider it. Consider the fact that there's nothing Elliott, there's nothing harmonic, there's nothing supply and demand, there's no support resistance, there's no Gann, Wyckoff, none of that stuff. There's just very generic price delivery mechanisms that I'm teaching you to look for. And while it may feel like there's a lot of them and a lot of moving parts, you're going to find now going through the second year, for those that just obviously complete their first year here, it really wasn't as much as you thought it was. There's just a lot of figuring out on a personal level how you're going to work with the information you're learning, because you're going to find that you don't need every one of these moving parts for your model to work. And it's liberating for you to realize that, obviously, but then it's much more comfortable when you realize that your model does not require every aspect of the things that you learn here, but it doesn't diminish the things that you're learning that don't use. Okay, so it could be easily argued by someone saying, oh yeah, you have a lot of fat, it needs to be trimmed off, and it should be something given to all of us to use, and it works for everybody. And that is misinformation. That's ignorance, because you cannot make someone be a scalper. You can't make someone be a day trader. You can't make someone be a position trader. You can't make someone be a contrarian. So there's all kinds of approaches that you personally could adopt in the things that I'm teaching you. But the things that are generic, that are static, that absolutely must be understood is the money flow that goes through a full calendar year. You have to understand that cycle that goes through, and then understand the seasonal tendencies that are factored in, and if that seasonal tendency is even going to be followed during that given seasonal time period, because that tells you, as I mentioned in a recent video, there's probably a mega trade there that you may not otherwise expect to see. But long story short, this is a beautiful depiction of what I've outlined for the month, and we're just still stuck in that range. All right, so we have a hourly chart, euro dollar. You have an imbalance in here. Cut through all this. SIBI, premium high, discount low, consequent encroachment. Look at the bodies. Nothing in here is clear about that. See that? The bodies are respecting that old imbalance. There's your support and resistance, folks. Okay, that's how you're looking for quote-unquote support and resistance. Every other form of it is highly subjective. There is no imbalance cutting through. There's no imbalance here. There's no imbalance here. Boom, there it is. Draw it through all the candles. And there it is. Buy side. It rallies, runs in, and then we have potentially low resistance liquidity run signatures here, and then maybe a revisit back to the daily range high. I'm not suggesting it's going to likely do that, but you observe and study it. And if it does, you annotate it, log it in your journal. You are not attached to anything emotionally, psychologically, or monetarily right now in the month of December. If you're feeling any regret or animosity or disgust or just fear that you're going to miss out on something more because something like this moves, that's just your infancy. That's just your newness as a student, understanding what you're looking at. These things repeat, but you want to be looking for them when the markets are more likely to give you high precision, low risk, not zero risk, low risk, and also know with a great deal of certainty which side of the market's going to reach for. because you can't frame this. You can't frame it where it's high probability. It can be looked at after the fact, and that's just hindsight tricking you. But when we are on side in other times of the year, not in this last portion of the year, it's easy for us and easy for me to frame out where it's likely to go, and I'm siding on one side of the marketplace. I'm not bracketing the market and then saying, well, this is what happens if it does this and that. We want to be looking at times when it's easy to frame it one-sided, like it's going to go for buy side or it's going to go for sell side. And if you can't frame the other side, then you probably have high probability for the side you're looking for. In this environment, it can go either way. And that is the definition of low probability. Understanding that characteristic and those traits in the marketplace helps you not only avoid potentially going into drawdown, it helps you also if you just really have to take a trade because your system's calling for it. And say we're not in December, but it's just another area of uncertainty, but it doesn't have the highest degree of probability. Those are instances, and this is for your journal, folks. Those instances are when you do not use your maximum leverage. So you would expose yourself to the lowest threshold of risk because you want to engage the market, but you know that the certainty is not as high as it would be in high probability, and you're learning. So how do you shield yourself? You don't go out there swinging both hands, with swords saying, I'm going to take everything on and come at me, bro. You don't want to do that. Okay. You want to go in with realistic expectations. Okay. If I lose, it won't hurt me much, but if I win, it's encouraging. Why don't you put the maximum risk on? Because if you can't frame it with high degree probability, why would you put maximum risk on, right? Whereas a neophyte, like I did when I first started, I wanted to put the biggest risk on I could. I wanted to use the largest leverage I could do when I was trading commodities, and it was such a anxiety attack, like every little tick. And I was always looking at my quote track, which is like a little machine. It looked like a big cell phone back then with a big telescopic antenna. And I would watch the market tick up and down, and every time it would move against me, just one tick, it felt like someone was cutting an inch of flesh off my arms. Like it was torturous. The only reason I felt it like that was because I was using too high of a leverage. So the balancing act is you want to use proper leverage, proper risk management, so that way you're able to sleep, but you're not ignoring the trade either. So you care enough to make sure the first thing in the morning you want to get up, you're going to check the chart and see where you're at. You do not want to be in a leverage trade where you can't fall asleep and you have to keep checking it. That's high. It's too high of a leverage. And you're going to find that in circumstances where the market is not as high probability, and you'll know this by experience in the things I'm teaching you throughout the calendar year, these times, if you're trading, it's going to be real hard to be relaxed in the trade, even with low leverage, because it's going to be echoing in the back of your mind. You know you shouldn't be doing this right now. You know you shouldn't be doing this right now. And what's going to happen is you're going to either learn through that pain not to put yourself in that situation anymore in the future and be more comfortable about your decision making and following your method, but doing it in the highest degree of probability. That is your goal as a trader. You want to be identifying environments where risk is comfortable to be assumed and leverage is comfortable to be used. Even the highest form of leverage that your money management allows. Not ridiculous gambling, but you want to be able to balance all those things out so that way you can live your life but not be worrying about every little minor fluctuation. 15-minute time frame on euro. Again, you can see the return back into that imbalance, premium high, finding support, and then running on buy side. So in my mind, I see this as short covering, and they're inducing short covering also by repricing higher. And British pound daily chart failed to get below those lows, trading below mitigation block here and the low here, so it's just banging around. We have a buy side liquidity pool resting rate in there, so that'd probably be the near term draw in case it wants to go higher. And here is the hourly chart. Again, I mentioned the other day on Monday, I was watching this and I was expecting it to go down below that low, and it didn't do that. And the fact that it didn't do that, again, is one of the characteristics of this type of environment where it's not as precise. But then we go into a short covering environment where we have mitigation block. We trade down into it here. We rally, order block, trades off of that. Institutional order flow entry drill with a breaker. Low, high, lower than this one here. You see that? So this low with a lower low and the high in the middle, that's a bullish breaker. We can trade inside that if we know order flow is bullish. I'm not suggesting that you would. I'm not suggesting that I called that. I'm just saying the way you annotate it so that we can have it in your study journal. Bullish breaker inside that range. Then we have institutional order flow entry drill. Trade right below that into this buy side imbalance, sell side inefficiency. And then it rallies. Another institutional order flow entry drill here. And rallies. So we have original consolidation, distribution, redistribution, smart money reversal, low risk buy, accumulation, reaccumulation, and then rally. So we have buy side resting above here. And the 15-minute time frame. I mentioned on, I think it was Monday. I'm not sure now. I think it was Monday. Yeah, it was Monday. We did reclaimed PD arrays. And I talked about this imbalance here and how we filled it in. We would expect bearishness to unfold from there. We did. We saw it go lower, and then we returned back to it here. So this is a reclaimed PD array. It starts to sell off, and I said that if we go back to it again as a third time, we do not and we would not expect this area to offer resistance. We would expect it to give way, come back down in, and find some support. Now this is a little muddy in here, and we traded back down in this imbalance a little bit. But this, I would attribute that to the fact that we're towards the end of the year, and it's this holiday volume. But when I was talking about using reclaimed PD arrays, and if they've been reclaimed, we do not see them do it like a third time. We would expect them to fail and run through that and then use the levels as support. In this instance, we look for it as resistance or a premium, and then it's going back up into it here. Go back and listen to Monday's video again, and you'll hear me outline the very thing that you're looking at right here. We trade up and through it. It doesn't even stop here. So it's not resistance. It's not like this high here and this high here. That's resistance, because look what it did. And it's not, it's breaking here and coming back down like you would expect it to rally here with support and resistance ideas from the retail crowd. Nope. Then it goes down here. How's that support and resistance? It's not. But watch what happens. It rallies back above. Boom. Then it hits the level. Premium high right there. The logic is we went through it, disrupted anyone that wants to buy it, and then we trade down into it as a Judas swing here. Consequent encroachment. Rallies. Market structure break. Institutional order flow entry drill. Rally. 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 Each new pass is squeezing on anyone that's short, inducing short covering for long-term bears on pound versus dollar. So this is right out of what I taught on Monday and how to use reclaimed PD arrays, but also understanding when they have been reclaimed. On the third time revisit to it, you expect them to fail. Okay, so when you look at things like when I'm on YouTube videos, or if I've done videos where I'm annotating the chart live and typing up what I think is going to happen, or it's going to do this, or it should respect that, or it shouldn't do this and shouldn't do that, I expect it to run through this level. It's this very logic I'm using to do those types of things. Okay, it's the element of reclaimed PD arrays, and then once they've been reclaimed, they are no longer effective in the original form of either premium or discount. They will likely invert, okay, and whatever they were using as a narrative for bearishness in the past or bullishness, it will be used for the opposite later on, and you can see that here. So hopefully this has been insightful to you. Hopefully it helped, put a little bit of a bullet point on what I've taught you on Monday, but I promised you I'd talk to you about reclaimed order blocks. So
I wanted to kind of like simplify this. That way you can appreciate now, because of all the things you've learned under the core content and the ongoing cumulative effect of commentaries that I do with you every week and just about every day of the week. That will obviously slow down when we get into 2022. I have a couple more months where I have to deliver like this still, but the pace will slow down, way down. But my work in the forum in each user group will be, much more pronounced. You'll see me a lot more there because it's easier for me to post things, charts, and manage my time in my personal life a lot easier and better versus making all these videos and different copies and user group watermarks. It's just too much work. But I can still teach a lot, and you'll get a lot more bandwidth, you know, with more concise things in teachings in the forum. I know you guys like videos and all that business, but there'll still be a video each week. But I just gotta slow down that pace. All right, so bullish reclaimed order blocks. Okay, so there's lots of things you can do with order blocks, but when we're looking at the element of reclaimed order blocks, the first and foremost thing is you have to understand where is it likely to go. Okay, where's the draw on liquidity? So now you've seen just about a full year, and all of you that have not just joined in the last group that joined in 2021, you have several years now under your belt in terms of modeling the money flow cycle that goes through the entire calendar year. So we know there are times when we can look for a draw on liquidity, and a bias can be determined based on that. But that has to be understood. If you don't understand that, you're not going to know what a reclaimed order block is. You're not going to be able to identify it real time, and you won't be able to trust the logic. So that's why I teach the way I teach, in terms of understanding where the market's likely to go and what barriers would be there that would prevent it or slow it down. So that assumption is being used here in this teaching. But we're going to assume that you believe that your analysis calls for a higher draw on liquidity, okay, or buy side liquidity. A reclaimed order block, and there's a couple things I want to cover in this because this is a really crude depiction, but it'll still accomplish the means. The short-term low that forms, okay, it's going to be some kind of old low that's ran out with sell side raid, or it's trading down into a discount PD array that you would expect to see prices rally from. So that's an ideal scenario. The market rallies and creates a short-term high, breaking market structure. Okay, so this could be a short-term high, or it could be another short-term high over here. But once that market structure has been broken to the bullish side of the market, then you're going to go right back to this down close candle. That is your order block. You're going to wait for it to return back down into it. That's your first run into the order block. That's a buy. Your stop goes below here. The way I teach you in this mentorship is you're not strangling your positions with your stop loss. In other words, you don't enter, and as soon as you get this one candle up, you don't go from your stop here to right under there. The reason why is what I'm showing you here, because it can return back into that order block again. Now, the first return to the bullish order block, that right there is the ideal entry, because you may not get a reclaimed order block. And here's the thing. You will never know, I never know, if they're going to reclaim the order block. I don't know that. Okay, and I'm going to tell you how you can trust that it could still potentially happen and when it's no longer a factor. That's what I'm going to show you here now. Once you get the order block traded to, and if you enter there, you want to see it repel. It does. You go back to the point at which this point number 3, that's where market structure broke to bullishness. Okay, so in other words, there's some short-term high over here, or maybe over here that's not being depicted here, because I want to take your attention to the heart of what makes a reclaimed order block. Number 1 spot is returning that down into the down close candle. That's your bullish order block. That's what you buy. Your stop will be below this low by 1 or 2 ticks or pips. When it starts to rally, that's what you want. You want to see that. But it can do this, fall short of where it broke market structure, and then go right back down in, take out that candle that you entered on, and go deeper into the order block. That is a reclaimed order block at point 2. What makes it a reclaimed order block is because we did not take out the high that formed the break-in market structure. So we're stuck in what? We're stuck inside the dealing range between the low that starts the order block here and the high here. So every retracement since this candle's high, we're stuck in this dealing range. Okay, so the logic is the order block was used to take the long entry here. Your stop is framed with a stop below here. When we dig down into it deeper, this is a reclaimed order block. It's returning back into this down closed candle. You would expect the likelihood of that happening because we did not yet, on this run here, from the entry up to here, we did not take out that high. Now, once it does this and it rallies again, you're waiting to see this high taken out at 0.3. Once that occurs, you have now broken market structure twice to the upside. There is no reclaimed order block with this candle here again. It won't do it again. For it to come back down to that again, that's a failure of the trade, and you would protect your stop by collapsing the trade before it gets your full stop. Very, very simple, isn't it? Now, for some of you, you would look at this and say, man, this is really simple. Like, why didn't you just teach it like that the first time? Because you don't have a full calendar year behind you, so that way you can see instances in your memory referring back to, yeah, I understand that, because you have, again, been exposed to more things that led to your understanding that makes this example far easier to see and understand and digest than if I just would have just said, here, look at this. Because you're going to worry about a lot more candles to the left over here that isn't useful. This is the underlying factors that you have to be worried about, assuming that you understand that the draw on liquidity is somewhere up here. But you have a down close candle that starts a run that sees a break in market structure that's bullish. It returns to the order block here, you buy. It rallies but fails to take out the area where it rallied to break market structure to bullishness. Then it retraces back down. It's dealing inside this range from this low to the high. You're trusting your stop will not get tagged. If it does, so what? So what? I'm not teaching you 100% trading because I can't do 100% trading. But you have to have logic in what you're doing and what you're looking for. So when the market trades back down, you're not panicking. It may go lower than where you entered. You may go into a little bit of a drawdown on your trade. It's okay. Let the stop do its job. That's what you're paying it for. You're paying it good money, hopefully not too much money, but you're paying enough to do its job to protect your account from blowing out. Because if it goes below that low here, that's not good. It's not bullish. But it can dig a little bit deeper into this order block, go deeper than your initial pass, then that's what's occurring here. That's a bullish order block that's being reclaimed because it has yet to take out the area where the high formed breaking market structure to bullish. But now you have this dealing range it has to overcome. And you're anticipating the draw on liquidity up here somewhere being the eventual draw for price to go higher. And they see price drop it down in here. And that all this is doing is the algorithm allowing interbank traders to pick up more buying in here. And then it rallies. Now, for your notes, where this first return in the order block and then where it goes back down into it again for the reclaimed order block, in other words, revisiting an old order block, you only allow that twice, never a third time. But in addition to that, the time from where it first goes into the order block and when it reclaims, there is no time limit. There's no time limit. There's no definitive number of candles. There's none of that, okay? So that's why you have to focus on this range high and this range low. And then expect the distortion of time in your chart because there's going to be periods between where New York session closes and then Asia opens. There's slow periods. You're not worrying about that, okay? So you have to anticipate a lot of meaningless movement in here, but not taking your stop and not taking out the high that creates the run on bullish market structure. So when the market just trades in like a tight range and it doesn't look exactly as nice and neat like this, in between these 2 points here, 1 and 2, this might be hours of data. But I've shown you how to remove periods of the marketplace. I physically took the parts out of the chart and show you what my eye sees. And I'm showing you here, by example, the range low and the range high. That's what I'm factoring my attention on. And I don't care how many candles it spends in here after it hits the order block here. I don't care. So as long as my stop hasn't been taken out, I'm going to hold the trade with the expectation it's going to eventually move in my favor. And I might have to submit myself to the time of hours before it gets into the next trading session, like London or New York. But while it's trading what would be viewed as aimlessly or in narrow consolidation, then it might drop down into that area here, and it will look like to other traders, oh, it's breaking lower, go short, when it's really just going back into that order block here that frames that range. So just like I outlined in recent weeks with the PAL dealing range and how effective that is, knowing what you're looking for, everything else outside of the range low and high is of no importance right now. What it's doing inside there, we're just trusting the logic that's going back down to the order block, and then it may go down to it later on and then create the run. So you have to submit to it, and just also understand that your chart is plotting price on a time basis, not a volume of trade or how much trading is going on. It's marking time with wherever the close is at that interval. And that's the problem with charts. And I do my best to try to help you decipher and remove all the chaff from that. So there's an element of time that allows you to just submit yourself to this logic. You have the order block and that old high where market structure is now bullish. And you want to see a second break of that to confirm bullish market structure. Once that occurs, then you don't ever expect this order block to be reclaimed again. The beautiful thing about everything I teach, everything is reversed. A bearish reclaimed order block is the same as what we saw here, just opposite. Market creates an up candle, trades lower, retraces back into that area here, which is your bearish order block at 0.1. And you want to see it break again, where 0.3 was a break in market structure on the bear side, some kind of short-term low here. It broke there. Then the retracement back into the bearish order block. That's your entry ideally. But it starts to go lower, but doesn't break market structure a second time bearishly. So we're dealing inside the range high and low. It returns once more back into the bearish order block here at 0.2. Then you would expect price to deliver like you were expecting. That's the other factor. Reclaimed order blocks, much like propulsion blocks, they usually provide a real quick, snappy reaction. Okay, so if you're seeing lethargic action, then you get a return back into that bearish order block at 0.3, down into a second run of bearish market structure being confirmed. So you have market structure being broken to the downside here, bearish order block, reclaimed bearish order block, then deliver quicker, faster pace run to confirm broken market structure to the downside, and then reaching for your draw on liquidity. And again, between 0.1 and 2, where there can be a reclaimed bearish order block, there could be a lot of time there, and as long as that dealing range high and low hasn't been given way, you just submit yourself to it and the stop. Okay, it seems like an oversimplification maybe, or it may seem like it's really overcomplicated. It's just a matter of how much you've studied through the core content and the cumulative commentaries I've done throughout the weeks and days each month of the year. But it's a really simple process. It's not complicated. You just got to go through your charts and look, and you'll see many examples of this actually occurring. And it occurs on all time frames. It's not just one particular time frame that reclaimed order blocks occur on. And that, my friends, is going to be it. And I will touch base with you again with a lesson. And I don't have my heart set on any one particular one yet, so we'll just see next Wednesday which one it is. I'm going to wish you all a very, very warm and memorable Merry Christmas. I'll probably put something up on the community tab of my YouTube channel Christmas Eve. But apart from that, I will be radio silent. And I wish you all a very, very festive and memorable holiday. Merry Christmas.